So thank you for registering for Life Insurance Basics, or thank you for watching this video about life insurance. I've been helping people with life insurance for 16, 17 years now. So it strikes me as what's kind of a difficult conversation, kind of a dull topic that's also horrifying and frightening for bringing forward things that we dread happening. So I was really pleased today to see how many people had registered to watch. So it's quite a good news thing, I think. So let's hop into it. These disclaimers, normally I skip over them, but in this case, it is pretty important. We're going to talk about very specific product types today. We don't describe particular product companies, but we do talk about class level of product. So it is worth noting that I'm not recommending anything. I'm trying to provide information here of a factual or general nature. Please don't take any decisions or actions based on this presentation alone. Be sure to obtain personalized financial advice before you make any decisions about insurance, be that acquiring, disposing, or maintaining any cover that you may seek in the future. And as always, we are recording this, I believe. I'll pop back over and check. But we are recording this, so this will be posted on YouTube, and it will be, as always, sliced up into things that are a bit more palatable, perhaps, for shorter videos. Making sure the recording is on. Good. Okay. Insurance is it's kind of a necessary expense. We put insurance into the worries bucket when it comes to our budgeting work. So you've got needs, wants, and worries. And I think it is akin to a fire extinguisher that you may have put aside. You never want a fire to occur, but should it occur, you want to make sure you've got all the measures in place to protect you, your family, your belongings, your financial future from those consequences. So if we think of insurance as a fire extinguisher, I think that's quite a good place to start. There are, in the insurances that I work in as a financial advisor, there's four main types. So I should flag there, I don't work in the general insurance space, so home insurance, car insurance, landlord insurance, anything like that. That's not my area. It actually exists under a different act. It's a different legislative arena. So I'm talking about life insurance today, specifically life insurance, which pays a lump sum in the event of your death or a terminal illness. TPD insurance, total permanent disablement insurance. And we will hop into these in more detail shortly. I just want to do a bit of a quick overview. This pays a lump sum in the event you are unable or unlikely to ever work again due to medical reasons, obviously not a voluntary retirement. The third insurance is trauma, otherwise known as critical illness insurance, which pays a lump sum upon the diagnosis of a predefined medical condition. And the final one is income protection, which pays an income stream. So that's the primary distinction there if you're unable to work for medical reasons. So the bit that we cover there, obviously the definitions, the distinctions across, I think we have 10 different insurers in Australia. There's always a little bit of a tweak, but broadly speaking, these are the definitions that will apply and that make these products distinct. So I will point out, just in terms of pricing, life insurance tends to be the cheapest, simply because while we all die, it tends to be later in life, so our likelihood of claiming on that is a little bit lower. Trauma tends to be the dearest because it covers defined medical events like cancer, heart attack, or a stroke, which sadly are awfully common across the community. So they tend to be larger. So they tend to be lower amounts of sum insured or lower amounts of cover. Income protection kind of sits in the same bracket because it's claimed upon so frequently, it makes it quite expensive. And TPD tends to be the least claimed upon, but tends to have the biggest financial impact in my experience. So it's relatively cheap dollar for dollar, but you tend to need a lot of it. So that kind of brings the price up as well. All the different policies work together. So I'm going to go through that in a second. Yeah, there's just so much ground to cover. So I think a good port of call here quickly is just how insurance works at a very high level. The bigger the population of people contributing to the pool of money that's underpinning this, relative to the number of claims that are coming out, the more profitable the insurer is, and therefore the cheaper the insurance will be. So while it's a pain in the neck, I mean, anybody watching this may well have had some pretty big increases in the last few years, and a lot of that's due to questionable decisions made by insurers. The reality is we need more people contributing to the pool. So the solution for insurance in Australia to make it more viable is not to just keep shopping the same people around different insurers, is to bring new people into the pool. So if you know anybody that might be interested in insurance, get them to start looking into it pretty quickly, because if they can join and if we have enough people can join, your premiums should drop, hopefully. Not a guarantee, but they should. Now, we call it life insurance, but in reality, it is death insurance, hence the very maudlin and morbid. I mean, there's even some fog in the background of that image. The reality is that we all will die, and it's talking about how do we protect our families, our loved ones, the people we leave behind against the financial implications of that happening earlier than expected. So, what life insurance or death insurance is used to cover? Primarily, and for most of the people watching this, you will have come to us through Loan Gallery, so you will have some sort of finance in place. So it'll be no surprise for you to learn that it's mainly used to extinguish loans. So a big lump sum comes through, people then pay out the mortgage, leaves their family in a home, pays out any investment loans. So we have somebody at the moment we're doing some insurance for, home, 4 other investment properties, fair amount of debt. But their insurance structure will clear home plus 2 of the investment properties. The extra cash flow from that should maintain the loans on the other 2 properties. If not, their plan is then to sell one of the other properties. So the reason I'm explaining that as well is that there is a logic behind how we calculate how much cover you need. So our next webinar in 2 weeks, we'll talk about that logic in more detail, but just to know that there's no one size fits all approach, and we take a lot of different things into account. The other one it does is it pays out non-investment debts, so credit cards, car loans, things like that, which will free up the estate. Now, there are conditions that apply here. One that's very relevant. So we do a lot of work on the estate side. So deceased estates, widows, things like that, or people like that. In that scenario, one thing that I've learned along the way is that insurance proceeds that are paid into an estate cannot be used to clear the debts of the deceased. They need to be paid out to the beneficiaries, and then the beneficiary needs to choose what they're going to do with the loan. So it's just worth being aware of that there will be a time lag if money is paid into the estate. And it's also as good a time as any to highlight, definitely, if you're looking at this, arrange a will. And don't arrange a post office will, don't arrange an informal will using post-it notes or a text message. Engage a qualified and experienced estate planning lawyer, an expert, and they'll draft a good will. They're not cheap, but it'd be well worth the investment. I'm dealing with somebody at the moment whose father died without a will, and it creates an awful lot of administration mess. Okay, so it's also used to keep your family on track. So you can replace your income for a period of time. So if you're in a family where there's a breadwinner and there's a stay-at-home parent, the breadwinner passes away, how do we replace that income? How do we make sure that family can maintain their lifestyle for a period of time to allow for the grieving process and the adjustment that comes with that? Now, that might be replace your income for 5 years. It might be replace your income through to the age of 65. It might be anything like that. Again, it's very much trying to decide whether I like using this phrase, but it's horses for courses. The other part of it is covering school fees. So if you had always intended to send your kids through private school, life insurance can be used to meet that cost. As I'm going through this, you might start thinking the numbers are going to start adding up, and they do. We don't place a lot of insurance that has less than $1 million of cover, simply because, standard mortgage, some living expenses, school fees, they add up pretty quickly. And I think I've heard all of the jokes about this becoming a motive for a true crime book or a true crime show. So don't do that. It's not worth it. It's also used to cover the final expenses. So it's the cost of settling the estate. The cost of settling the estate. So that can be lawyers' fees. It can be conveyancing fees, valuation fees, all sorts of things involved in that. It also covers the cost of the funeral itself. So funerals can get fairly expensive. The dearest I've seen so far is $45,000, which kind of blows my mind. But for each person and for each culture, there are different obligations that come with a funeral, so they can be quite expensive. Now, you can own your death insurance. You can own it personally. Tends to be the tidiest way to do it. Tidiest upon application and tidiest upon claim. You can also own it via superannuation. Superannuation comes with some tidy little tax benefits, and also cash flow benefits. So you're not paying for it out of pocket every month or every year. You can also own it through a business if you are self-employed. That is a specialist topic that's beyond the scope of this webinar. I mean, in reality, all of this is. So before you make a decision about how you'd like to own your insurance policy, be sure to get personal advice, because there's lots of considerations at play. Now, are there some signs you might need it? Now, I think people in my seat will often assume that everybody needs life insurance. It's not the case. But some people that would have things like, if you were to pass away, would your family be left with more debts than assets if you excluded the family home? If not, if you included the family home, are they going to have to sell that in order to make ends meet? Would your family be able to cover your household living expenses for at least 3 years? So do you have savings put aside to cover that for 3 years? Do you have sufficient superannuation to cover that? Again, we don't know that for sure. But ultimately, at the moment when they've lost, a member of their family, would they have to sell the family home? A lot of people would like to do anything they can to ensure that their family can keep the family home. That's just worth flagging. If your family would need to sell it, then arguably you need life insurance. If your family would need to sell it and you would prefer they keep it, then you are likely to need life insurance. Signs you might not need it. So, would your death mean that there are simply enough assets to cover all debts, leave your family with a reasonable nest egg, say 3 to 5 years worth of income, but also cover living expenses? And that could be by virtue of having multiple investment properties, a share portfolio, healthy superannuation, really low living expenses as a family. That's another possibility as well. In that event, I would argue you very possibly don't need life insurance. Again, not everybody needs it. So that's life insurance in a nutshell. Now we move on to the one that for me is probably the most terrifying, because I think, total permanent disablement insurance, it's not easy to claim on, for starters. You have to be totally disabled for a permanent disability, and it needs to be really complete. So it's a very disruptive and enormous change in your life and the life of your family, not just your immediate family, but probably your extended family too. There are physical effects of this, there are mental effects of this, emotional, psychological, psychosocial, all of these things. So it's a big, huge meteor that hits your family. So let's talk about it. So TPD insurance commonly, will come to how it's held normally, but it's used to, again, extinguish loans. Except in this instance, we're paying out the loans with the proviso that you're still around. So because of that factor, simply that you're still around, TPD insurance tends to be a bit higher than what you need for life insurance, because we want to pay out the mortgage to make sure you've got a roof over your head. We want to pay out any investment loans that you want to generate enough income to help subsidize your new cost of living, or to sell the properties debt free. And also to pay out any non-investment debts. Cash flow is really critical. If you're never going to work again, then we need to close the gap between your new expenses, which will probably have accelerated, and your potential income. We need to close that gap as quickly as we can. Otherwise, you find yourself in real trouble. And I think it's worth noting here, we have a safety net in Australia. It's pretty good. You do not want to be relying, though, on the disability support pension in order to make ends meet in the instance where you're disabled. You instead want to be that person who is buying the upgraded wheelchair, or is renovating their house to accommodate their physical limitations, or who can afford the best therapeutic care to manage their mental health, to make their life as positive as possible. You do not want to be scrimping and saving on DSP if you can avoid it. So it's also used to cover those medical and adjustment expenses. And in my process, when we're calculating how much insurance people need, we break this component down between initial expenses and ongoing expenses. So initial expenses are, okay, my life has changed, completely. What do I need to give myself the best standard of living I can with the greatest dignity I can expect with as much independence as possible? So that might be a wheelchair. It might be renovating the house so the doors are wider, benches are lower, and you can fit in a specialist bed with a lift in your room. It might be stuff like covering the cost of hospital visits. Even things like parking can add up really quickly. If you're seeing a loved one in the hospital every day for 3 months, realistically, what's that? $50, $60 worth of parking a day? So what's that? Across a week, you're talking 300, 600, 1,200 across 3 months. All of a sudden, you're up around $5,000 just in parking fees. Plus the inevitable food you buy at the cafe downstairs when you're trying to get a break from the room. You want to make sure they have nice clothes that they're comfortable in. You want to make sure all these things. So it's just to give you that extra bit of money. Now, the money doesn't kick in straight away, but it will reimburse the expenses you're incurring. Then you've got the ongoing medical bills. So medication is a huge thing. You may be on PBS medication, pharmaceutical benefit scheme, or you may not be. You do not want to be making a decision, I think, about your medical care based on the financial restrictions you live with. You also have specialists that you need to see. So you might be seeing an occupational therapist every 3 months for 3 years. You may have there's a whole gamut of specialists you may need to see: psychologists, psychiatrists. You may start your period of TPD with a physical disability, but that often, or physical condition. That often has very powerful mental health and psychological implications down the road as well. Also paying for equipment. I mean, I don't know if anybody watching this is a Seinfeld fan, but I think that captures pretty well the fears I would have about using a cheap secondhand wheelchair. Um, if you can afford to, you want to be buying the best equipment you can. And finally, looking to replace your income. And this is a kind of a complicated topic. So again, this is something we'll cover more in our next one. But income protection covers you up to 70% now of your income, of your gross income currently. Now, if your living expenses are the same as they are, let's say we get rid of the debts, but still we replace that with ongoing medical bills, and you still need that extra 30%, you can use TPD as with a calculation to replace that income. We don't do a huge amount of it, but you can do it. The other one is, again, keeping your family on track. I mean, it's always really hard. That's not really hard. I mean, we have the easy part of it, but when we have a client who is disabled and we arrange the claim on their insurance, they get a big payout. It's all very sad and tearful, and it's awful. But it's finite. That stage ends. The money's paid out or it's not paid out. When it's paid out, then our client and their family, their life is on a very different track than it was previously. So we're not in the picture anymore, but I know that they need to change everything in their life. You need to change your car, you need to change your transport arrangements, you need to change, you know, where do you get meaning from if you're no longer at work, if that's a big part of your life? All these things. So what I like TPD insurance to do is to keep everything that can be kept on track on track. Pay the school fees, replace the income, replace your spouse's income if they need to stop working. These are things that TPD insurance can be used for. A lot of people, I think, over the years have told me, "Oh, I've got enough to cover my mortgage," which is great. A couple $100,000 will make a material difference. But where does that leave you 5 years from now, 10 years from now? I think that's where TPD insurance, a proper holistic approach to TPD insurance done by a financial advisor, can make a huge difference. So in terms of ownership options, again, with TPD, similar to life insurance, you can own it personally, you can own it via superannuation, or you can own it through a business. And again, tax and cash flow considerations for each different option. So be sure to get that specialist advice. Owning stuff through superannuation can be very good because you get a 15% tax deduction within superannuation for owning the policy. So if your premium is going to cost you $1,000, at the end of the day, your super fund pays $850. The downside is, particularly for TPD, there's tax payable when the benefit is paid out to you if you're not careful. And that $850 a year is eroding your superannuation balance. So you would almost always want to match that with some sort of contribution plan as well. But again, we're riding into advice territory there, so I'm going to be careful. Some signs that you might need TPD insurance. And I have come across, a few people over my years where they haven't needed it at all. They just had the wealth or the security behind them to meet their goals once they'd articulated them. But if you and your family would be left with more debts than assets and be forced to sell the family home, I would argue you probably need TPD insurance. If you'd be unable to cover all living expenses for at least 3 years, because it's a huge adjustment as a family, but if you're trying to make ends meet at the same time, I reckon you might need TPD insurance. So as you might need it again, are you simply rich enough or wealthy enough that you can cover all foreseeable expenses and capital repayments? Could you clear enough of the loans to make the properties positively geared? Do you have enough money put aside or able to generate enough income to replace your income? If that's the case, you probably don't need TPD, but have a think about it and talk to somebody to get some advice. Trauma insurance. This is the one, like I say, it's the most commonly claimed on. I think I saw the stats change, but it's 1 in 3 trauma policies. No, misleading. 1 in 3 Australians will have cancer by the time they turn 75. Obviously, that to 75 tweaks it a bit. But the reality is there is a huge proportion of Australians between the ages of 25 and 65 who will have a medical condition that aligns with the trauma insurance definition. Now, the big 3 for trauma insurance, like I said, are cancer, heart attack, and stroke. So cancer, they have very strict and clear definitions. If you've ever seen a product disclosure statement for an insurance company, go to the trauma section. They will direct you to where they define cancer, and it's about 2 pages long. Heart attack, stroke. So these are, I hesitate to use the word ideally, but the reality is ideally, these will be very short term, very acute, very serious conditions from which you will make a full recovery and return back to life. If you do not make a full recovery, then the other insurance options open up, TPD, and sadly, death insurance. So trauma insurance generally is for a very finite period of time. When I'm thinking about trauma insurance, I always think of it as cover for kind of a 2-year period. At the end of that 2-year period, you'll either know if you're going to make a full recovery, if you're not going to make a full recovery, or you'll be disabled, or is your prognosis even worse? So trauma insurance is quite different to TPD, and as a result, when I calculate it particularly, it tends to have a lower amount of cover you need. Part of that also reflects the higher cost. So you'll see that trauma insurance in this case is used mainly to maintain loan repayments. So we're not clearing any loans. We just want to maintain those payments for 2 years. So maintain the mortgage payments, maintain the gap for an investment loan. So if you're renting it out at $450 a week, but it's costing you $750 a week, we make sure that trauma allows for that extra $300 a week. And also what we do is eliminate any non-investment debt. So any credit cards, personal loans, car loans, you want them gone, but the other ones we just try to keep up with the payments. The big area where trauma insurance is really important, I think, is its coverage for medical and adjustment expenses. So again, it's supportive equipment, it's those hospital visits, but it's also a diversity of treatment options. So in Australia, we have the PBS. There's a list of approved medications. They are heavily subsidized by the government and far more affordable. But often people, particularly with cancer treatments, some of the more exotic illnesses that are listed in a trauma contract, sometimes they're given other options for treatment. And I think if trauma insurance can make that discussion a personal decision discussion rather than a financial limitation discussion, then I think it's really important. For instance, if I were to be diagnosed with cancer and my oncologist said to me, look, we've done as much as we can here. There is an experimental trial in the US, but it's going to cost you $300,000. It'd be really hard for me to accept that I couldn't do that because I didn't have the right amount of trauma insurance. So, look, I mean, insurance it's a guilt purchase. Like, it's not something I'm trying to emphasize, but just that is something that trauma can be done to add extra value to your nest egg, so it can give you that diversity of options. Because it'll cover, you've got all those ongoing expenses. We have a client at the moment who has just finished up her chemo and radio treatment. Wasn't hugely out of pocket, but she had to travel 2 hours every day to the hospital because she lived regionally. Her husband stayed overnight every time. So there's all these other expenses that go with it that trauma can be used for. But again, it's also about keeping the family on track. Because it should be a temporary condition, you don't want your family and your financial life to have run down to zero in the interim. Ideally, I think you want to be able to pick life back up once things are back to quote unquote normal. So help with the school fees for 2 or 3 years, supplement your income for 2 to 3 years. And one of my favorite ones is put aside an amount of money, if it does make it to the end, just to go away for a week or so. It's different. Client of mine, her husband passed away after a long battle with cancer, and she just got back from a 3-week trip to the Gold Coast with her kids, who are all in primary school. And it was just what they needed. It had been a really long battle for 18 months. He'd then passed away. Things are a bit messy with the will and the estate. So she used some of the trauma money to cover that holiday cost, which I was really pleased for them to be able to do that. Now, ownership, you cannot own trauma through superannuation. There are some historical policies that are owned through super. They're outside your reach. Questionable whether or not you should even keep it. But you can own it personally. You can own it through a business. Now, they really apply here, these conditions. Business trauma cover can trigger all sorts of capital gains tax issues. There can be all sorts of considerations. So just to repeat myself, make sure you get advice. If you needed it, if you were diagnosed with cancer, could you take 6 months off for treatment? Could you find 200 grand for a non-PBS but highly recommended treatment? And could you cover all of your debt repayments without working? Now, I couldn't really fit it on the slide here, but a few years ago, I had a client tell me, this was about a year or so after their trauma claim for breast cancer. She said that one of the things she was most grateful for is that when she was sitting in the chemo room getting the treatment, she was able to just sit there and read a book and talk to her friend who had brought her and just be in the moment and focused on what was going on. 2 seats next over from her was another woman who was going through the same chemo, but was frantically working on her laptop to make sure she was keeping up with her workload. And look, more power to her. Absolutely. If that's a choice she's made, fantastic. But I just think when you have a life-changing event like cancer, to have the financial freedom to not be drawn back into the workforce or to be worrying about emails while you're getting poison pumped into your veins, strikes me as a pretty good use of the money. Besides, you may not need it again. Are you wealthy enough that you could cover 2 to 3 years of all expenses and capital repayments? Do you have enough cash put aside to do that? Not superannuation, unless trauma illnesses are not automatically a condition of release for super. So if you already do not have access to your superannuation, you're not of that age, then that won't change under a trauma claim. Income protection. I've used a unicorn here, a unicorn money box, because this is the unicorn of insurance policies. Income protection, when you are unable to work for a medical reason, and that's signed off by a doctor, you then wait 30, 60, 90 days, whichever you choose. And after that, it'll start paying you 70% as a maximum of your former wage. You pay tax on that benefit payment as it comes out, but you claim a tax deduction on the premiums. It's a very unusual product in the realm of life insurance. But it's fantastic because this is what you will live on in the event of a claim. This is generally used in tandem with TPD or trauma insurance. If you're not able to go to work for medical reasons, you will start getting paid. Now, I'm simplifying the claims process. It can be challenging, but ultimately, if you meet the conditions and the definitions, you should be able to claim. You can't really own it through a business. There is a policy or a product called business expenses insurance, which is ownable via a business, but it comes with a very different need. It doesn't cover you individually. It covers naturally the expenses of the business. But you can own income protection personally or via superannuation. I will make I think I'm safe to say this. Generally speaking, if you can afford it, it is better to own a policy in your own name than via super. The quality of the contract is generally better in your own name. You can claim it as an individual tax deduction, the entire amount. And upon claim time, the money comes to you directly. It's just a lot tidier. So for that, in this case, I think there's a clear winner of what's preferable. Again, if you can afford it. And that's where the superannuation can become a little bit more attractive because it can help defray that upfront cost. Again, you may not need it. If you couldn't work for 2 years, would you lose your home? If not, maybe you don't need income. Maybe you don't need income protection. Do you have a way that you could pay your bills? Is your spouse's income enough to meet your needs? Well, then maybe you don't need income protection. Although that is, of course, subject to you maintaining that spouse, keeping that spouse, but also making sure they keep that ability to earn that money. I think also just how much stress can you carry? Having a medical thing occur consumes a lot of your cognitive bandwidth. To then allocate much more of the extra to the stress of making ends meet, I think can be quite counterproductive. So if you can, and it is suitable, income protection is worth looking at. Now, I want to talk very quickly just about who's who in the zoo, and also just to put this fantastic picture forward, because how good's that? Stack of flamingos walking around a zoo. So just a bit of jargon to go through. So life insured is the term for the person over whose life the insurance policy is held. Now, strictly speaking, other people can hold an insurance policy over your life, but it would need to be with your cooperation because you need to fulfill the disclosure requirements. So you need to answer all the medical questions. But life insured is the person we're talking about over whom, when the event happens to them, then the policy is triggered. The policy is then owned by the policy owner. Now, commonly, the life insured and the policy owner will be the same person when they own the policy personally. But sometimes it can be a superannuation trustee that owns the policy on behalf of the member. So you'll see in your insurance paperwork, X, Y, Z trustees or PTY Ltd as trustees for X on behalf of client, which is you. Policy owner you can also have cross-owned policies. So husbands and wives can own policies across the other person's life. Never recommended anymore. Used to be a big deal in the 80s and 90s, I think. But really not a good idea because you may not always be together forever. And there's very few exes that want their former partner running around with insurance on their life. Beneficiary is who the money goes to in the event of a claim. Life insurance it'll never be the life insured, basically, unless you are under a terminal illness claim, which is where you are likely to pass away in the next 12 months. The insurer will pay out the money, and then that will be to you, most likely. So in that case, often the beneficiary is somebody else, a spouse, their estate, kids, something like that. Beneficiaries of TPD insurance will be you generally, so the life insured and the beneficiary are likely going to be the same. Same with trauma insurance. Beneficiary is simply the person who receives the money after the claim is approved. Now, the insurer end, there is the insurer. So you have any number of different insurance companies in Australia. You've got, just off the top of my head, AIA, AMP Resolution Life is still in the market for existing policies. You have BT, you have TAL, you have Zurich, you have MLC. You have all the new ones as well, MetLife, NEOS. There's quite a few. There's quite a breadth of options. PPS for specialists and for professional occupations. So they all have like their little niche. They all have their terms, but that's the insurer. Now, the insurer employs an underwriter to assess your individual application, and an underwriter's job, because under the Insurance Act in Australia, you have guaranteed future insurability. Now, what that means is that once you are approved for an insurance policy, the insurer is on the hook for that policy for as long as you keep paying the premiums. So in theory, somebody at 18 could apply for a trauma policy and have that through until they turn 65. And as long as they keep paying the premiums, the insurer can't change the terms of the contract, and they can't cancel the policy on you either. So the reason that's relevant for an underwriter is it's their job to start quantifying the risks that insurer is taking on by bringing you on. So a lot of that is around medical stuff. So if you're a 35-year-old person who discloses that you've had a backache or back pain, you may end up with substandard terms around back protection. So they may say, look, we will cover you in the event of a claim, except for one that's coming from back pain. So they do that analysis, they do that investigation, and they make the final decision. On the flip side of that is when you go to make a claim, the claims manager will do the same, but in reverse. They'll review the paperwork you've provided, they'll review your claims paperwork, your application paperwork, and make a decision ultimately about paying out the money. The reinsurer sits behind the insurer. So Australian insurers don't have big enough pools of money to carry all of the risk in their book. So what they do is they pay a reinsurer, often a big one out of Europe or America. One of Warren Buffett's biggest companies is one of the biggest reinsurers. They pay them an amount of money or a cut of the premiums to take on some of that extra risk above certain levels. Finally, APRA, you have the Australian Prudential Regulation Authority. They are responsible for managing insurers, making sure they have enough money put aside to meet their needs and to meet their likely future claims. So all the insurers collect all of the money that you pay them every year, and they pop it in something called a statutory fund. And the statutory fund is where the money is held and is invested very conservatively in order to meet their future obligations and liabilities. Okay. The other side of the coin. So everybody on this call or watching this recording is likely going to have an investment portfolio, be it a portfolio of properties, shares, crypto, superannuation, whatever. You will have a portfolio of different things that you own as an investment. I would argue that you should also, the other side of that coin should be an insurance portfolio. So it shouldn't just be a matter of, I've got life insurance. It should really be a matter, I think, of I have allocated my budget across all 4 insurances to give myself the greatest chance of having the protection I need when I need it, although recognizing the amount may not be adequate. So when we're working that out for your insurance portfolio, a big part for me as an advisor is just determining how much you need. And the level of cover you need will be different to every other person I've ever met, even to your spouse, because you will have different amounts in superannuation. You'll have different priorities when it comes to clearing debts and making repayments. So your individual needs analysis is a very complicated job, but I think helps to make sure the insurance is relevant for you and meets your needs. Your budget is a key factor as well. Insurance is not cheap. You will have a finite number of dollars that you can allocate towards paying for your insurance. So a discussion with a good advisor will be, okay, here's my headline number. How do you think we should best allocate that? Acknowledging that you will end up with a compromised level of cover because you may not have enough TPD in the event of a claim, or you may not have enough trauma in the event of a claim. But what you've done is you've cast the broadest net possible to try to give yourself as good a likelihood of getting something in the event of a claim. There's different ownership options. Like I say, there's personal, business, and super, plus a few others, but also talking about your plans and your trajectory. So we see a lot of people in their 30s and 40s who have a number of investment properties. Come their 50s and 60s, they will not need the cover that they need today because they will have paid down some of that debt. So is it worth going full for the insurance now while you've got the budget and then tailing it off over time, knowing that you may not need it as much into the future? So all very individual and very bespoke when it comes to preparing this kind of advice. Like I've said, for me, better to have some of all of the policies rather than none of one of them. So I rather see people have a little bit of life, TPD, trauma, and income protection than say, oh, trauma's too dear, I don't want that one. From my perspective, big believer in Murphy's Law, the one you don't have is the one that you will probably experience and then be really disappointed. Right. So our approach, this is where things get a little bit unique. So some of you may have heard before me talk about being an independent financial advisor. What that means under the Corporations Act is that I have chosen to not accept any sort of commissions or percentage fees. I also don't have any ownership or connection to product providers, but that commission piece is the really big one. So every insurance policy that's sold, not every single one, as a default, life insurance policies have a commission built into them. Now, for me as an advisor, if I were to write a new insurance policy, I think it's 66% of the year one premium, including GST, and 22% each year of the premium, including GST. Now, as an independent advisor, if I remove that commission, I tend to be able to reduce a client's policies by 20 to 30% because that commission is built into the price. So we don't take those commissions. So removing them can reduce the premium by 20 to 30% a year. Now, I should flag that instead of doing that, obviously we don't all work for free. I charge a fee for the work we do around insurance. So new advice for a new cover comes with a fee. New advice for existing cover, there's a fee. Alterations for existing cover, fee. Insurance claims, controversially among some of my advisor friends, I charge a fee for. So that way you're paying for the fee for the work that you need or that you want. You're not paying every year for me to potentially not do anything. Commissions is kind of a contentious topic. To be completely frank with you, they're better for clients, I think, than they are for advisors. But to give you an idea for the fees that we charge around insurance, so new insurance for a new couple, new insurance advice for new clients who I haven't met before, who are a couple, the fee for that starts at $4,950. So what that means is that if you're saving 20 to 30%, either your premium needs to be huge to make that back in the first year, or you need to accept it might take you 3 to 5 years to break even because that 20 to 30% saving is every year. Now, some people love that. Some people love being able to pay for the work up front and getting what they get. Other people would rather not. They'd rather defray it via commissions. Either way is valid. If you are looking for a commission-based option, we can refer you through to people that work in that space. It's just a decision that I've taken as an advisor. Where this becomes particularly relevant for any loan gallery clients at the moment, as you know, we are running a special promotion or a limited time promotion where we are waiving all of our advisory fees. So that doesn't include external advice fees, like if we have to get external assistance, but all of our advisory fees, which means you can get a policy, have the commission turned off, saving 20 to 30%, and not pay the flip side of that, which is that $49.50 fee. So it's for a limited time, and I should flag we're pretty busy. It's been a pretty busy time. So we have created a wait list for people to join into that. If you're on the wait list when the promotion ends, we will honor the fee-free commitment. But after the promotion ends, the date of which is coming, I don't really know when it is yet. That's up to management. We will be back to charging fees for the advice we're giving around insurance. Okay, how have I gone for time? I've flown through that. I feel like I've covered a huge amount of ground in a very short period of time. We have another one coming up, like I said, on the 9th of May, where we're going to talk about how much insurance do you need. It's going to be a live calculation through our needs analysis tool to help you see how we work out how much cover you should have. And I should really flag out that I calculate how much you need before I calculate how much you can afford. I need to start with what you need, and then we carve it back to bring down to something that's more affordable. They're my details. If you have any questions, be sure to send them through. I'm going to hop back over to Teams now and just give a few minutes if anybody should have any questions. But I should also know, if you're watching this on YouTube, just email us through hello@theadvicegallery.com.au. Yeah. Cool. All right, I'll just check the Q&A. Excellent. Give it another 2 minutes. We will finish it up at 1:15, so a little bit early today. If you have any questions at all down the track, to send them through. If I was talking too quickly, let me know as well. Like I say, I've been giving insurance advice for nearly 20 years, so it's all very familiar to me. But if it's not something you've done a lot of in the past, most people won't be looking at insurance all the time, so it can be a bit confronting to go through quite so quickly. Well, we'll go 2 minutes earlier. We'll call it there. Thank you so much for attending. Please be sure to sign up for our next one, and I will speak to you soon. Thanks a lot.